Edward Yardeni, President Yardeni Research, joining us this morning. Pleasure speaking with you as always, and thank you for your patience as we've set the context to this conversation. So much to unpack. Let's start with the big T, the trade war, the tariffs. Is it going to get uglier than here, or is there some hope? Are you taking heart from what Secretary Lutnick is saying that maybe we'll find a middle path?
Well, clearly, there's a lot of different messages coming out of Washington. Today, we started out the morning with a very tough message of 25% tariffs on Canada and Mexico, and a total of 20% on China. And all three of the countries announced retaliation. Market took a dive on that, then it recovered some, and then it took another dive. And then after the market closed, as you said, Commerce Secretary Lutnick indicated that by tomorrow, there might be negotiations that resolve some of these issues, which is mind-boggling. I mean, this is really creating a lot of uncertainty, a lot of chaos in the financial markets and in the economy. And I think we're all going to start learning to tune it all out. This is the art of the deal, but deals done in public, and it looks pretty messy. And I think we just have to kind of wait to see how all things settle out. I don't think that it's going to get much worse on the tariff side, but I don't know that for a fact. But I do think that Trump will get a lot of pushback from a lot of special interest groups, and that instead of seeing tariffs go up at the end of the day, we may actually see some negotiations that bring them down.
Dr. Yardeni, hi, morning. So if you tune out all of this, and there's so much to tune out, therefore, then what do you focus on? Because ultimately you'd be waiting for some time, and whether we like it or not, there are going to be implications for the United States, for its consumers, for its companies, because of these tariffs. So what do you focus on?
Yeah. Well, all I'm saying is, instead of starting out with the headlines of what's coming out of Washington, start out with the economic and financial indicators that the economy is generating. And admittedly, the latest batch of economic indicators for January looked quite weak, and there was a downward assessment of real GDP growth from over 2.5% to under to minus 2.5%. But you know, a lot of that was January data. January was the coldest January month that we've had since 1988. So I think a lot of the weakness in the consumer was that related to that. And we will, in fact, see a nice rebound in retail sales and consumer spending in February and March. In addition, a lot of importers decided that before the tariffs are coming, they might as well bring in more of the goods that they typically order. So we had this huge surge in imports in January, and that, from a mathematical arithmetic standpoint, lowers the growth rate of real GDP. That was the big drag on real GDP in January. And I think a lot of that's going to be reversed in February and March. So rather than expecting a negative quarter for GDP, I'm expecting plus 1.5%, maybe even better than that.
Well, and I believe Dr. Yardeni will add a line to this, that we reserve the right to change our minds as often as the President of the United States does, because that was the line. That was the line in his quick takes that came to the mailbox as well. But Dr. Yardeni, at the start of the year, you were in the camp of seeing the S&P 500 reach substantial highs. This morning, the mail that I've received says that, are the odds of a bear market rising? So I have a two-part question. One, are the odds rising for the US markets to give sluggish returns or negative returns? And perversely, could that be constructive for EMs or maybe just China? Because China has just laid out a 5% GDP target. They are, even if they're not throwing the kitchen sink at the economy, they are certainly trying to do what it takes, and the private sector is helping that.
Absolutely. I think starting with the United States, I'm counting on earnings to drive the stock market higher this year. I think we have started to see some real improvement in productivity growth. I think the technology revolution, including AI, but other things like robotics, automation, et cetera, there's a lot of technology that I think is boosting productivity, and companies are spending money on technology that does that. And so I think earnings are going to be surprisingly good this year. I'm not expecting a recession, but again, I have to But as I have to take that hedge clause, depending on what the president says tonight and tomorrow, I suppose. But with regards to emerging markets, I think the prospects are actually reasonably good, especially now that China has decided that, well, if the United States is going to slap a 20% tariff on China, that threatens their export model. So they are going to do whatever they can to stimulate fiscal spending. And by the way, Germany is doing the same thing, and the Europeans are going to start spending more on defense. So there's a lot of fiscal spending, a lot of stimulus going on around the world that I think will continue to drive growth. But it's not going to be red hot growth. It's going to be decent growth. I think commodity prices, including oil prices, are going to stay relatively low. But all in all, I think it's going to be a growth year for the U.S. Economy, for the global economy. I think India has already demonstrated that the growth rate is solid there. Bit of a sell-off, obviously, in the Indian market over the past couple of months. I mean, that's the price you pay for having a great bull market. Sometimes you have a little profit taking. But I think all in all, the outlook is generally good for stock markets around the world.
Dr. Yardeni, thanks so much. Pleasure as always speaking to you this morning. You bring some semblance of, understanding to this madness that we're facing on a daily basis. Thanks so much for joining us this morning.
Thank you.